Hello, everybody, and welcome to part 2 of our lecture on Chapter 5, Inventory and Cost of Sales. And where we left off on the previous video is I had posed a question. Now, what if, instead of our just basic sales entry, now we have a situation where we have 2 cans of Coke. One was our beginning inventory, which cost us $1. And then we bought an additional can of Coke that now costs $1.20. Then I go to sell one of these cans of Coke for $1.50. What is the journal entry to record the sale? Well, we talked about in the last video the basic sales entry. And we talked about how there's 2 parts, right? The revenue part and the expense part. Well, the revenue part is exactly the same, right? We still sold a can of Coke for $1.50, which was our selling price. So we did the exact same thing. We're going to debit accounts receivable for $1.50 and credit sales revenue for $1.50. But the expense part of the entry becomes a little bit more complicated. The accounts are the same. We're still going to debit cost of goods sold and credit inventory, but I'm not sure of the amount. Which can of Coke did I sell? Was it the one that was my beginning inventory that was $1? Or is it the second one that I purchased that was $1.20? They look completely identical. I don't know which one is which, so I don't know what number to put here. Well, this causes quite a dilemma. Excuse my software update. And this is a dilemma that a lot of businesses face because the cost of something isn't always the same. It's going to change over time. And in fact, you guys have experienced this in your own lives when you go to the gas station. Okay? Every time you go to the gas station and you look at their price board here, it changes often. That's why this guy is here and he's changing the price, as he probably does almost, every week or even every day. And if you look here, here's a chart of gas prices. And as you can see, they're going up and down and up and down and up and down. Whoa, really high up and then whoa, really low down and then up and down and up and down and up and down. Okay? This is something that a lot of companies face because you're not always going to be able to buy a can of Coke for $1. It's going to change. Sometimes it's going to be higher, sometimes it's going to be lower. And there are various factors that cause this. In general, when you're talking about commodities, things like gas, the main reason has to do with supply versus demand. And that's an economics concept. Basically, the thought being that if the supply is low, meaning we don't have a lot of gas out there, but the demand is high, meaning everybody needs gas for their car, so a lot of people want gas, well then your gas, they're willing to pay more for the gas because they really want it and there isn't that much out there. And then of course, if it's the opposite and there's a lot of supply, a lot of gas, but like nobody really wants it because maybe they're all buying electric vehicles now and they don't really need the gas, well then the gas prices are going to go down. Okay, so again, this is an economics concept. I'm not going to really talk too much about it in this class. I always have students who are like, well, why does it change? I never thought about that. That's the reason why most of the time is supply versus demand. And I'm going to give you a couple other examples where I have seen this happen in clients that I personally worked with. So I think I've mentioned to you a few times that most of my accounting career, I worked with apparel companies. And I had a few different clients actually that were t-shirt screen printers, meaning they would buy blank t-shirts similar to this one and they would print, logos or different artwork on it and then sell it. So when they bought a plain white t-shirt, the cost of that t-shirt wasn't always the same. It would go up and down. And the reason why had to do with the main ingredient that goes into a cotton t-shirt, which is cotton. Okay, so if the main ingredient, if there's problems with the supply and the demand of this main ingredient of cotton, it's going to impact the prices. So this again is a chart, and it goes over a few different years, and as you can see, it's going up and down and up and down and up and down, but then whoa, there's this huge spike here, and then it dropped it back again down to kind of normal. Well, what happened this year when it spiked up was that there was a drought in the cotton producing states in the South. So when there was a drought, it caused the cotton crops to fail. So there was less supply, but still a lot of demand because people still wanted to wear their t-shirts. So when the supply was low, but the demand was still high, they had to raise the prices because if you really wanted your cotton t-shirt, you were willing to pay more for it because there wasn't that much out there. And then when the season, when the drought wore away and the seasonal conditions got back to normal, the cotton prices went back to normal as well. Now, how this impacted my client was when they were doing their entries, journal entries, as they sold t-shirts, they didn't know if this was a t-shirt that I bought before the drought, during the drought, or after the drought. There was no way to know because they all looked exactly the same. They were all just a plain white t-shirt. Okay, so it was hard to know what number do I put there for my cost of goods sold or my inventory going down. Another example of this had to do with a Mexican cheese company called Cacique. You may have seen their products in your grocery store, but they make all these different types of cheeses. And their main ingredient, of course, to make cheese, you need milk. Okay, well, here's a chart showing milk prices. Again, going up and down and up and down and up and down and down and up again. And again, this has to do with supply and demand. Due to various factors, there may be more milk or less milk available as a supply. And so that causes these milk prices to fluctuate. And so then for Cacique, when they were dealing with, well, what milk did we use to make this cheese? Was it the cheaper milk or was it the more expensive milk? I don't know. I don't know what to put in my journal entry for the inventory that I used. So now you've seen some examples of how this can be problematic for companies. Now we have to figure out a solution for this problem, right? Because we have to record something here. We have to come up with a dollar amount here for this side of our sales journal entry. So how do we do that? Well, there are actually 4 different methods that you can use to come up with a number to put in the expense side of your sales entry. Specific identification, first in, first out, or FIFO, last in, first out, or LIFO, and weighted average. So we're going to start first with specific identification because that's the most straightforward. And specific identification actually makes it pretty easy to figure out which one you sold. And that's because the items are separately identified using some kind of code or number so that you know which one it was that you bought. So it says here that specific identification is used for unique items of inventory that can be separately identified. But this isn't appropriate for all different kinds of inventory. It really is only appropriate for inventory that is, number 1, unique, and number 2, a high dollar value item. So the 2 most common examples are this. Automobiles. Okay, this right here is a white Tesla, and it's not the only white Tesla of that model. There are others, but the way that we know that this is my white Tesla and not somebody else's white Tesla is because of the VIN number. VIN stands for Vehicle Identification Number, and that means that every vehicle is marked with a number so that you know that this is my white Tesla and that one over there is not mine. And this little chart here shows you all the places where your VIN number is going to be stamped on your car. So if you want to, you can go check your car right now and see if you can find it, usually like on the inside of the door right here, or down at the bottom of the windshield. I've never looked at this one right in the front, but apparently it's there too. Another example is jewelry. Okay, now jewelry, especially like high dollar value diamonds, have a little inscription of the number. And in fact, like my wedding ring, if I were to take my ring to a jewelry shop to have it cleaned or repaired or something like that, I would want to know that they're not taking my diamond out and putting a cubic zirconium in. So the way that I know, or maybe putting in a cheaper diamond in my ring, the way that I would know is I would look in a jeweler's microscope and I could find the identification number on my ring so that when the ring comes back to me, I can check to make sure that it's my same diamond that I brought to them is the same one I'm getting back. So, now the thing is this doesn't work with all products because it really is not cost effective to separately identify every single item. The reason why is because, there's not that many cars out there, certainly not as many as cans of Coke, for example. And also, when you're talking about a car or a piece of jewelry, we're talking about thousands of dollars. So it makes sense to separately identify those items. But if it's $1 can of Coke, it just doesn't make sense to take the time to separately identify every single item of Coke. Okay, it does not make sense. So again, keep in mind that this does not work for every single kind of inventory. Only for certain kinds that meet these requirements, unique and high dollar value items. So now let's see what this actually looks like as far as a journal entry. So with specific identification, now we're going to say when I sell the can of Coke for $1.50, I looked at the SIN number or soda identification number and found that the can I sold was the one that cost $1.20. Well, first of all, there's no such thing as a soda identification number. And even I always have students going, well, what about the number on the barcode? The number on the barcode just gives you the batch that the Coke was made, but that's like a Coke thing. It's not really something that once the Coke is at the grocery store, it's all coded the same thing to be a can of Coke. It's not linked to the cost that they bought it for. Okay, it's only linked to what they're going to sell it for. So there's no such thing as a soda identification number to tell you which exact can of Coke you sold. But just for purposes of our demonstration, we're going to say there was a soda identification number, and we know that the one we sold was the one that cost $1.20. So then now we can fill in the number here for cost of goods sold in inventory as $1.20 and $1.20. And then when we go to calculate our gross profit, we take our sales of $1.50, which is from here, and the cost of goods sold, which is $1.20, which we get from here. So price minus cost, and that gives us a gross profit of 30 cents. So now if we try to look at what happened in the flow of inventory, it kind of goes like this. In our beginning inventory, we had a can of Coke that cost $1. That's the first one that we bought. Then we added in the second can that we purchased for $1.20. So if you add those two together, our cost of goods available for sale was $2.20. Then one of two things could have happened to that can of Coke. Either I sold it, which as you can see here, this is one I sold because I see my customer drinking it. And that one I know was the one that was for $1.20. So that's going to go to cost of goods sold. The other thing that could happen is we didn't sell it, and therefore that's the can of Coke still sitting on our store shelf, but this one was the one that was $1, so that's our ending inventory. And so again, as you see, from the beginning inventory of $1 plus $1.20 equals your cost of goods available for sale, which is $2.20. And then that was divided in between what you sold for, which was $1.20, what you didn't sell, which was $1, and when you add those two together, you get $2.20. So all of our math here works out in our flow of inventory. And now I want to kind of summarize what happened, and we're going to use this chart to compare all of the methods. Under specific identification, in this case, our cost of goods sold was $1.20. Our ending inventory was $1. The sum of those was $2.20, which is our cost of goods available for sale, and our gross profit is 30 cents. Next, we're going to talk about the next method, which is first in, first out.